Hi, I'm attorney John Mangan, a board-certified lawyer in the area of wills, trusts, and estates. The subject of estate taxes is one that I'm often asked about from clients and potential clients. So we're going to spend a little bit of time today talking about that concept. Basically, estate tax is a tax that's levied by the government on the value of assets above a certain threshold. Today, for our purposes, we are going to focus on the federal estate tax. I practice in Florida. Florida does not have a state version of this tax, but just be aware that many other states do, particularly those in the Northeast, where many of our clients either move from or originally hail from. So the way that the estate tax works on a federal basis is we take a look at, upon the date of death, what are the value of all of the assets that the decedent owned? And when I say all the assets, I mean all. This includes not just assets that need to pass through probate. It also includes a portion of jointly owned assets. In many cases, it's going to include life insurance policy proceeds, of course, real estate, investment accounts, bank accounts, basically anything that the decedent either owned or had control of upon the date of death. And then we'll be looking at the corresponding value of those assets at that same point in time upon the date of death. So once we have added all that up and figured out what is the value of the estate, we compare it to the estate tax exemption amount, which as we're rolling into 2024 is approximately $13 million per person. Obviously, that's a high number that is set to be rolled back by Congress at the end of 2025, unless they take an affirmative action to the contrary. I actually did a prior video on this topic, so I'm not going to go too deep on it today. But just understand we are expecting a significant rollback in that amount, probably dropping the exemption on the order of 50% or so within the next 2 years or less. So once we have the value of the assets of the decedent and we compare it to the exemption amount, then we look at how much overage do we have? How much above that exemption amount are we? Because if we're below it, then no estate tax is likely to be owed. But if we are above it, then everything above the exemption amount is potentially taxable when it comes to estate tax. Now, what will that rate be? Well, the answer really is that it depends. There is a graduated scale that right now starts at approximately 18%. And very quickly, once we exceed about $1 million in that overage amount, we get up to 40%. So if we've got more than $1 million or so that's subject to estate tax, then you can expect to be paying 40% for everything above that point. Now, an important subject when it comes to the estate tax is when is it due? So it's due within 9 months after the date of death, although an automatic 6-month extension can be requested. And that's really, like I said, it's automatic. If you need the extra 6 months to extend the timeline from 9 out to 15 months, you're entitled to receive that. What that means is that the Form 706 estate tax return has to be filed by the deadline. So whether you're working with a 9-month deadline or a 15-month deadline, that 706 estate tax return must be filed by that. Now, we have seen circumstances where that relatively small amount of time to file the return and pay the estate tax causes significant hardship to the loved ones and the families of the decedent. I have a perfect story that really illustrates this concept. If you're a sports fan, you may be familiar with the former owner of the Miami Dolphins, Joe Robbie, who owned the team. I believe he passed back in the mid-1980s or so. Don't hold me to that, but approximately in that era. Now, when Joe Robbie died, the vast majority of his net worth was tied up in the value of the Miami Dolphins. And because he hadn't done any proactive advanced planning, that estate tax was due, whether it was within the 9 months or the 15 months. It required him to have to liquidate the team and sell it. So the team could not be kept within his family the way that he probably would have liked. But that just illustrates the hardship that families can endure when planning has not been done in advance. The real problem there, of course, was a lack of liquidity. We didn't have liquid assets that were available to pay the estate tax. Now, this is where life insurance can be extremely helpful, particularly if we're working with the estate of a client where we don't have a lot of liquidity, where we have a lot of net worth that's tied up in business interests, or real estate. Life insurance can be structured so that we can provide immediate liquidity upon death, and we have that money then available to pay the estate tax prior to its deadline. So now that we've defined what estate tax is, and we understand that it's going to apply when we are above that estate tax exemption amount, which, by the way, that's assuming you haven't made any significant lifetime gifts. You may be saying to yourself, gosh, I don't want to pay 40% above that amount, Uncle Sam. That's a lot of money. And you know what? You're right. That is a lot of money. Now, fortunately, there are some widely accepted, established methods of really either deferring, minimizing, in some cases, eliminating estate tax. So I'm just going to mention a couple to you today. Obviously, there are a lot of other techniques available. Perhaps that will be a subject for another video. So one that is commonly used is one that we will refer to as the unlimited marital deduction. So what this means is you can essentially leave your spouse as much money as you want upon your death, as long as it's done in accordance with IRS regulations, which means it could either be an outright distribution or it could be made through a couple of specifically defined types of trusts that the IRS has authorized. Let me give you an illustration of this. And just to paint an extreme example, let's say that you have a lot of real estate that's worth $100 million, and you leave all of that $100 million worth of real estate to your spouse upon your death. You're not going to owe any estate tax. Your estate is not going to owe any estate tax, at least on that $100 million worth of real estate. Because you're leaving it to your spouse, that $100 million worth of real estate will now be in your spouse's taxable estate. And unless he or she has done some planning on their own, then potentially they will probably have to pay estate tax upon their death, but at least it delays the payment of the estate tax. And in some situations, depending on the timing of the deaths between two spouses, we may be able to kick the can down the road for many, many years, which can have some significant benefits to your loved ones, not just your spouse, but children, grandchildren, and whoever else it is that you might want to benefit. Now, a second technique that's often used is sometimes referred to as a freeze out of asset values. I think an illustration here again will help to clarify exactly how this works. Let's say that you've got, and I'll make this example more run-of-the-mill and simple, but let's say you've got $1 million worth of Apple stock. It's worth $1 million today. Now, 10 years from now, let's say you pass away. That $1 million worth of Apple stock probably grows to $2 or $3 million. That $2 or $3 million, if you have not done any planning, that's part of your taxable estate. In other words, the appreciation that occurred, it all took place inside of your taxable estate. On the contrary, if you were to create a trust with an attorney who specializes in this area, like ourselves, and you put that $1 million worth of Apple stock into the right type of trust, you can freeze out the future appreciation so that all of that extra $1 or $2 million on top of appreciation takes place outside of your taxable estate. Now, normally when we do this in the form of a gift. So the $1 million would be gifted from you into a trust, and you file a gift tax return. It's a Form 709, and that $1 million then would come off of your lifetime exemption that's applicable towards the estate tax, or in this example, the gift tax as well. So you've essentially avoided paying 40% estate tax potentially upon that extra $1 or $2 million of appreciation. And all appreciation that takes place even beyond your death, it still stays outside of your taxable estate and the taxable estates of your loved ones if the trust is structured in the right way. So you can see that when you work with somebody who's knowledgeable and expert in this area, you can save your estate and your loved ones significant sums of money in terms of estate tax. Okay, so now we've reviewed what estate tax is, its definition, how and when it might apply to you, and also a couple of techniques that can help to minimize or reduce the consequences of estate tax. If you have any questions that are specific to your situation, or you'd like to have your situation reviewed by an attorney who's an expert in this area, please feel free to reach out to our office. We're here to help. We look forward to hearing from you.